Okay, let's dive right into this explainer. Today, we're taking a magnifying glass to the intense market hype surrounding the highly anticipated SpaceX IPO. But we're doing it with a twist. We're tossing out the fanboy excitement for a minute, and we're looking at this strictly from the sober, calculated viewpoint of a fiduciary wealth advisor. Because look, when your actual life savings and client portfolios are on the line, you have to peel back the sci-fi narrative and look at the cold, hard math.
And to set the tone, listen to this brilliant analogy from Kyle Taylor, a portfolio manager over at TriDelta Private Wealth. When he was evaluating this IPO, he hit the nail on the head. He said buying in right now doesn't feel like getting in on the ground floor. It feels like, quote, parachuting onto the roof of a skyscraper, while the pre-IPO investors, the insiders, take the elevator down and walk out the front door. That is exactly the danger everyday retail investors are facing here.
So here's our game plan for the audit. We'll quickly run through 1. The trillion-dollar hype. 2. The orbital AI vision. 3. The Starship bottleneck. 4. Crunching the real numbers. 5. Fundamentals over flash. And finally, number 6. The passive index trap. Let's get into it.
Starting with Section 1, the trillion-dollar hype, and how they're pricing this IPO. $1.75 trillion. I mean, let that just wash over you for a second. That target valuation is absolutely monumental. At a projected $135 a share, SpaceX is pricing itself higher than Meta and Tesla combined on a revenue basis. To put that in perspective, to be even remotely on trend with standard tech valuations, a company needs somewhere around 150 to 175 billion in annual revenue to justify a price tag like that. It's a valuation that literally requires flawless execution for years.
And get this, what's truly wild is the float allocation. In a normal IPO, companies carve out maybe 5 to 10% for retail investors? Not SpaceX. They are carving out a massive 30% for the everyday buyer. That's not an accident. It's a very deliberate, strategic choice. They are leaning incredibly heavily on the Elon Musk retail hype train to absorb this massive valuation the second it hits the market.
Okay, Section 2. The orbital AI vision. Data centers in space.
So to even try to justify a trillion-dollar price tag, SpaceX had to change the story. It's not just about rockets anymore. It's an aggressive pivot to becoming a space-based AI conglomerate. They merged with xAI at a $1.25 trillion combined valuation. But here's the crazy part. To beef up the balance sheet right before going public, they essentially turned into a hyperscaler landlord. They're renting out their terrestrial data centers to competitors. Google is paying them $920 million a month for access to 110,000 NVIDIA GPUs. Anthropic signed a $1.25 billion a month capacity deal. All of this cash is just meant to fund their ultimate endgame, escaping the power grids of Earth and putting AI data centers in orbit.
And the roadmap is, well, it's insanely ambitious. They want to deploy 1 gigawatt of orbital AI computing capacity by late 2027. That means building a completely new satellite, the AI-1, with massive solar panels handling 120 kilowatt computing load. That is basically an entire NVIDIA GB300 AI server rack floating in space. Oh, and they want to deploy up to 1 million of these into low Earth orbit. Which brings us to Section 3, the Starship bottleneck, or the delivery problem. Here's the reality check we desperately need to talk about. If you're a fiduciary, you have to look at the engineering risk impartially. And the truth is, literally none of this space AI stuff happens without Starship. The current Falcon 9 rockets, they simply cannot lift these massive 120 kilowatt satellites in bulk. And Starship is currently lagging behind its initial timeline. It hasn't proven the rapid, dirt-cheap reusability that this whole plan hinges on. If Starship gets delayed, the entire $1.75 trillion AI narrative hits a massive brick wall. Moving to Section 4, crunching the real numbers inside the S1 filing.
Let's look at the actual books because the S1 filing reveals exactly how much this AI pivot is costing them. Now, Starlink is a phenomenal business. It pulled in $11.4 billion in revenue in 2025, and it's actually turning an operating profit. But it is dragging a massive anchor. The xAI infrastructure costs pushed the overall company to a devastating $4.28 billion net loss in just the first quarter of 2026. The AI division alone burned through $2.5 billion in a single quarter.
You really have to weigh this intoxicating futuristic vision of space computing against the reality of a severely bleeding balance sheet. A wealth advisor looks at this and sees a jaw-dropping accumulated deficit of $41.3 billion. They see a company valued at 94 times its total revenue, just hemorrhaging billions in cash every few months to build these data centers. It's a grand vision for sure, but financially, there is zero margin for error here.
Section 5. Fundamentals over Flash. SpaceX versus Chewy.
This is where we contrast this incredibly speculative asset with what advisors call a boring but durable stock. Kyle Taylor used this exact comparison, and it's perfect. He puts SpaceX up against Chewy, yeah, the online pet food company. On the left, you've got space lasers, AI, $1.75 trillion valuation, and 0 quarterly profits. On the right, you've got literal dog food, but that dog food comes with 0 long-term debt and a highly sustainable cash flow.
When you're building a portfolio that needs to survive decades of market swings, these are the traits you actually want. 0 long-term debt, real cash flow, sticky recurring revenue, like how 85% of Chewy sales are just automatic auto-ship orders, and manageable valuations that don't rely on hype. Just ask yourself, comparing those boring metrics to SpaceX's current cash burn, which company is actually going to survive a sudden recession?
And finally, Section 6. The passive index trap and structural risks.
There's a hidden mechanical risk here that could really burn everyday investors. NASDAQ recently updated their rules for fast entry index inclusion. What this means is that on June 27th, literally just 15 days after the IPO debut, massive passive ETFs that track the NASDAQ 100 will be forced to blindly buy SpaceX stock, regardless of whether the price makes sense. That's going to artificially pump the stock up, right in time for the insider lockup period to expire in December 2026, which is conveniently exactly when all the early insiders can finally dump their shares on the open market.
Plus, you can't ignore the governance risk. Thanks to a dual-class share structure, Elon Musk holds 85% of the voting power, even though he only owns 42% of the actual equity. So, to put it bluntly, one guy can completely dictate the future of this massive company. Public shareholders are footing the bill for this massive cash burn, but they're getting absolutely no say in how that capital is allocated.
So here's the trillion-dollar question I want to leave you with before you put a single dime into this IPO. When you strip away the hype, the amazing rockets, and the sci-fi promises of AI and space, are you actually investing in a fundamentally sound, durable business for your financial future? Or are you just subsidizing one man's incredibly expensive mission to Mars? Take a hard look at the numbers and decide for yourself.